I'm very happy that everyone joined us today. This is just the first of 4 webinars on backtesting. It's a long series that we're starting today. Obviously, we can't cover everything about backtesting today, so please be patient and join us again for the other webinars. And now I'm going to welcome Alex Christoph, our Director of Education. Alex, please go ahead.
Thanks, Doran. Good afternoon, everyone, and welcome to the continued educational webinar series by Algorithmic Traders Association. My name is Alex Christoph. I'm the Director of Educational Programs with Algorithmic Traders Association. In this webinar, we will discuss the very basics of one of the cornerstones of systematic trading, that is, backtesting. Since we're doing our best to keep all our discussions as formal as possible, let's start with the definition of backtesting. You may be surprised, but sometimes even this seemingly straightforward term is interpreted in different ways. So, we believe that backtesting is simulation of trades taken according to any rule or a set of rules using either historical market data or artificially generated data. In case simulated trading is done using historical data, the researcher believes that backtesting provides an approximate representation of what would have happened in case the examined trading system worked during this particular period of history. It's important to understand that even if the strategy performance on backtested data is good, this test alone does not guarantee future performance. As you can see, we could discuss future performance only in case we are sure that future market data will be somewhat similar in its nature to the data used for backtesting. We will get back to this important issue a little bit later. If with backtesting on historical market data it's more or less clear why we would want to do it, then you may wonder why we would want to test it over artificial data. There may be 2 reasons, and surprisingly they exclude one another. First, we may want to make sure that our strategy works on virtually any data, even random. Well, we all know that truly random data don't exist, therefore we rather test if our system is able to react to a data set with a certain distribution, for example Gaussian. Second, we may want to make sure that our strategy does not make profits out of random data series. This is important in case the strategy aims to exploit a specific market process that exists only in one market and may be encountered only during a specific period of time. Let's consider a simple example that would help us better understanding the idea of using artificially generated data for backtesting. Let's suppose that we have a trading system that exploits opening gaps, a simple strategy that used to work in many American markets some years ago and still works in many emerging markets. It's clear that such a system is able to make profits only within a relatively short time window, actually around the market opening. If we replace the market data with artificially generated data, then we shouldn't have any sign of steady performance anymore. If we do, this means that our initial strategy design actually doesn't exploit the opening gap, but exploits something else. And you know, it's not a good idea to trade something that you don't understand, even in case it seems to perform well. At this point, we have to make an important remark. Backtesting itself has zero predictive power. Remember that we already noted it when we considered backtesting of historical data. It doesn't tell us anything about future performance of a tested strategy because it is not its main purpose. Then, what is the main purpose of backtesting? in order to understand the purpose of backtesting, we need first to go even for the definition of a trading system. There are as many definitions of trading systems as trading systems themselves, but in case we discuss directional trading, we can consider a trading system as a traffic light. In case the market goes up, it just passes market data through without changes. If the market goes down, it just passes market data with an opposite sign, turning negative into positive. And in case a system is not able to decide about the direction, it simply doesn't pass data through. Of course, it's a very simplified model, but its key feature is clearly understandable in this example. A trading system performs a segmentation of price data according to the trading algorithm, which in turn should be based on a trading idea. Therefore, in case such a segmentation is done with a valid trading idea, the foundation of a system, then we can see positive performance, normally in form of a growing equity curve. The worst performance of a trading system in reality is the situation like this. If we can't see any persistency neither in growth nor even in decline. This kind of a performance curve in most cases means that either the trading idea was not adequate to this particular market, or what is a more common case, that there was no trading idea at all. So even this very basic and surface visual analysis of equity curves helps assessing the validity of trading ideas. Well, not bad for a start. Now we're ready to answer the question about the main part of backtesting. Backtesting tells us whether the trading idea and the trading system that is based on this idea are adequate to that very period of history in that particular market. Moreover, backtesting is the only tool that allows to say at least anything about the reaction of this particular trading system to various market conditions. Even though backtesting itself has zero predictive power, it is the only method to see whether the very trading idea has ever been valid for this particular market. And here, I'd like to draw your attention to something that is so seldom recalled in virtually any discussion on backtesting. I think you all know that there are intervals in historical data when the trading strategy performs better, and there are intervals when it underperforms or goes into a drawdown. However, it's very seldom when researchers attempt to explain these intervals and see if there is indeed any correlation between them and real changes in market conditions. In other words, backtesting data may become extremely important when we analyze the adequacy of our trading idea. If neither run-ups nor drawdowns in the strategy can be explained by changes in the market conditions, then most likely the strategy was generated by so-called notoriously known curve fitting and seemingly has no future. This way, we could summarize that backtesting done right is only the first step to the analysis of robustness of a trading system. And even you can see a nicely growing equity curve, it is of course necessary, but not sufficient for the system to be really robust. It's often possible to hear an opinion that backtesting is useless because it uses only past data and markets always change. Therefore, there is a risk that as soon as the strategy is set to trade live, it starts to lose money even if it showed positive performance on past data. I can understand the origins of such an opinion because such a situation is not uncommon in systematic trading. We will consider the reliability of backtesting in most details in one of the future webinars. And for today, we only want to understand which information we can get using backtesting, how to interpret it, and whether it's at all useful for trading systems development. Now, given the application of backtesting is to test the validity of the trading idea and the consistency of the trading system, we should look into the limitations of the method that may significantly affect the relevance and reliability of backtesting results. Data quality plays a very important role in the overall backtest reliability. You need to be very critically thinking when you decide which data source to choose. It's one thing if you want to backtest a strategy that generates trading decisions based on daily data and holds positions for weeks. And it's another thing if you're going to backtest a high-frequency arbitrage strategy that averages less than a single tick and holds positions for microseconds, if holds them at all. The proper choice of the very software for backtesting is no less important. You need to be absolutely sure that the software of your choice is capable of testing strategies using exactly the required granularity of data and frequency of trades. For example, it is not uncommon when a backtesting engine erroneously interprets the entry or exit conditions, and you can catastrophic results it may lead to during live trading. Last but not the least, the backtesting software should be capable of simulating the real trading environment. It should be able to account for trading expenses, realistically simulate execution of orders, something that we will consider in details in one of the upcoming webinars, by the way, and ideally even simulate various unexpected events that may affect performance. For example, occasional software failures. Only a test that reproduces the real trading environment can give a more or less clear idea about reasonable expectations from live trading. So far, we discussed only visual analysis of equity curves. This is an important part of the research, but not the only one, and not the most precise one. Indeed, like most visual analysis techniques, this method is more qualitative than quantitative. This means that we are able to make certain conclusions about the general behavior of our trading system and even see how it performs under various market conditions. But when it comes to comparison of different trading systems in order to decide which one is better, of course, having some numbers would be very useful. Therefore, we can use a number of metrics which represent various features and parameters of the trading system and compare numbers and not just visual impressions. Of course, we shouldn't forget that no single metric is sufficient to provide an exhaustive survey of the analyzed system properties. We need to analyze many metrics, most of which can be divided into three major classes: integral metrics, dynamic metrics, and benchmark metrics. Let's start with integral metrics, as those are the very familiar to most traders. A typical example of an integral metric is the average trade value. This metric normally serves as an initial filter to sieve out trading systems that are not exploitable in real life. For example, if you design a trading strategy that generates attractively looking equity curves, but which average trade value is less than 1 tick, then most likely such a system cannot be used in reality, even if it uses only limit orders for both entries and exits. Return on drawdown is another important metric which basically tells us something about realistic expectations of returns given the known risk. For example, if the system features a return on drawdown ratio 1:1, then it means that you risk, for example, $1,000 in order to expect a return of the same $1,000. If the return on drawdown ratio is, for example, 3 to 1, this means that you risk only $1,000 in order to expect a return of $3,000. So it's obvious that the higher the ratio, the better the performance. As a reference, typical directional trading systems feature a ratio of 3 to 1 or 4 to 1. We could say it's a kind of an industry standard. Profit factor is the ratio of gross profit to gross loss. Generally speaking, we can compare this metric to boiler efficiency, how much coal we should burn in order to heat the water to a certain temperature. Same here. One thing is if we reach the known net profit in just 10 trades, and another thing if it took 100 or 1,000 trades to do the same. It's evident that profit factor should be greater than 1, otherwise the system is losing money. Profit factor can be very efficiently used to check if the system was over-optimized, or, as traders like to say, curve fit to the market data. Normally, in this case, profit factor reaches unbelievable values like 4, 5, or even higher. Although it may look very encouraging, in fact, it's a bad sign. Unlike integral metrics that only transform the trade data into a single scalar value, there is another class of metrics that aim to compare the overall strategy performance to a known benchmark. In this case, if this benchmark is acknowledged by most traders, or even better by most investors, then such a metric may be important. However, sometimes benchmark metrics are considered as the only meaningful metrics and other metrics are not taken into consideration. This is incorrect because if the benchmark itself is chosen improperly, then the value of such a metric becomes meaningless. For example, an attempt to use Sharpe ratio to assess the performance of market-making strategies provides incredibly high values, which unfortunately don't say anything about the stability and reliability of these strategies and their possible performance in the future. Now, let's quickly summarize the most basic, the most essential steps in analysis of backtesting results, which would at least provide with the least degree of confidence. Of course, this list is not complete, and it is absolutely impossible to discuss all details of backtesting and strategy robustness assessment in just one webinar or 2 or 3 webinars. We thoroughly consider them within our educational program towards Certified Algorithmic Trader Certificate. However, even these simple steps allow to at least throw away strategies with doubtful trading ideas behind them and therefore avoid issues with live trading. First of all, we should check if the average trade value is sufficient. Remember that if your strategy averages 1 tick or less per trade, then most likely it is not tradable. A good practice is to consider strategies that generate at least 10 ticks per trade on average. However, of course, this value may vary depending on the holding time, trade frequency, and many other parameters. Next important step is to check whether your strategy outperforms a respective benchmark. Normally, benchmarks are various indices, and it's very important to choose the one that is appropriate for the market your strategy is trading. For example, S&P 500 is most heavily used as a benchmark for all strategies and all markets, but it would be correct to use it only for stock markets and associated derivatives. For other markets, there are other acknowledged indices. For example, for currencies, there is SGIFX G10 that is published by Société Générale and so on. And last but not the least, check whether your strategy performs exactly in line with changes in market conditions. For example, if your strategy works best in highly volatile markets, then there is not surprise to see it underperforming when volatility is low. Of course, in order to be able to perform such a check, you need to have very good knowledge about the market you are going to trade. However, in my opinion, this is the absolute must for any serious trading systems developer. You have to know the market you are going to trade. And that's why we pay very particular attention to market analysis in our educational courses for traders and trading system developers. And finally, let's go back to the original question. Why do we need backtesting if it doesn't have any predictive power in itself? The answer is that we may suppose that certain market conditions will repeat it. And if they do, then we already know what to expect from our trading strategy and therefore make an adequate decision to increase exposure, to decrease exposure, or at certain times even to stop trading the strategy completely. Sometimes this is the wisest decision that allows to avoid unbearable losses. So as you can see, the world of backtesting is very diverse and interesting, and mastering it requires a lot of practice, understanding of advanced models of market structure, as well as decent knowledge in statistics. For those interested in becoming proficient in this domain of systematic trading, and not only in this domain, to become proficient in systematic trading in general, we offer intensive and comprehensive educational program that is called Certified Algorithmic Trader. And I'm going to speak a little about this program. So for those that attended today's webinar just to learn the very basics of the essence of backtesting, I'd like to say thank you for your attention. And for those who are serious about their career in trading, in systematic trading, and interested in learning more about the education with Algorithmic Traders Association, simply please don't disconnect. And after that, I'm going to answer any questions. So the CAT, or Certified Algorithmic Trader program, can be outlined in 3 stages. The first stage, or the first part of the program, is completely, totally dedicated to market analysis. We understand the market structure, the forces that drive prices, the typical behavioral patterns of market participants, and so on, so on. This gives us an understanding of how to exploit the known market processes that are not only existing in our mathematical formulas, but really exist in the market. The second stage is to convert this knowledge, this qualitative knowledge, into quantitative algorithms. Then how to properly backtest them using all the knowledge that we have by that stage, and how to properly use optimization, because I think you know very well that sometimes optimization may lead to so-called curve fitting, and therefore to generating systems that are not tradable in the future. And the final part, the most advanced part, is about the design of portfolios of both trading systems and markets, and money management and risk management. So the first stage, as I said, includes the analysis of market as a superposition of actions of market participants. We learn how to identify ideas that work in the market and may work in the future, and how to convert these ideas into codes. In the second part of the course, we learn how to properly do backtesting, because remember, what we discussed today are only the very, very, very basics of backtesting. And of course, how to use optimization correctly. For skeptically thinking traders, I would like to make a special remark that mostly we do not use optimization in order to just find the best set of parameters to a trading strategy that just generates the maximum net profit. Rather, we use optimization as a tool that allows us to analyze the stability of a trading system. Therefore, we use it in a very unusual way and at the same time very efficient. And finally, we learn how to create robust portfolio. Very important thing, how to manage operational and systemic risks. And also very important, also a sad knowledge, is how to identify the moment when it is useful to switch off a system. The normal requirements for the candidates to this course are, let's say, very basic programming skills. This means that if you ever programmed anything successfully, then it is okay. We don't expect a high level of mastering, I don't know, C++, for example. No, it is not required. But anyway, you have to have some background in programming. Also, you need to have sufficient background in mathematics, at least to understand a very, very general concepts from statistics. Again, we do not use complex mathematical formulas. This is not a course in mathematical statistics, but you need to have at least some basic understanding of it and the ability to understand the explanations of certain notions from statistics. We work in small groups that do not exceed 3 students, and we try to combine students into these groups so that they all had more or less similar level, more or less similar background. We meet once a week in online class that lasts for 1 hour and a half or 2 hours, perhaps even more sometimes. And for the rest of the week, there is a lot of homework, a lot of assignments, and during the rest of the week, we work through email or through Skype, and so that by the next class, this part of the course is accomplished, and we can proceed to new knowledge. Normally the course lasts for 3 months, perhaps maybe a little bit more, because as you say, as you've seen, there are 3 stages in this course, and each stage takes approximately 1 month, maybe a little bit more, with a couple of classes. And of course, if you had any experience with TradeStation or multi-threads, it would be a plus, because all the examples that we consider during the course are made in easy language. This doesn't mean that if you, for example, are proficient in NinjaTrader or any other platform that uses C# or C++ or Java or any other programming language, then it would be impossible for you to participate in this educational program. No, it is possible. Only all examples that we consider are written in easy language, because this language allows to generate codes that are most easily read by humans. It is so close to the spoken English that it is possible to analyze these codes and write these codes on the fly during the class. And of course, after that, if you have sufficient proficiency in any other programming language, you can translate these codes into the programming language of your choice. So, thank you for your attention. And in case you need more information about our educational program and certification, please feel free to write to info@atissm.com. You can also do that by filling up a form at the classes page of the site. You can see links on the screen. Don't forget to visit and subscribe to our YouTube channel. We post the recordings of all free educational webinars. And now I'm ready to answer questions if there are any. How about crude oil and S&P futures? Well, if you mean the programs or strategies that we consider as examples within the course, yes, normally we consider a couple of strategies that work for ES, for E-mini, and for CL. MQL4 for MetaTrader. Again, let me repeat. If you are proficient in MetaTrader programming, okay, you can translate the codes or, well, remember, the idea of the course is to teach you how to create your own trading strategies. This approach is platform independent. If you are proficient in this particular trading platform, then you will be able to correctly interpret your trading ideas in this platform's language. Again, I provide examples only in easy language because the programming in easy language looks like if close is greater than open, then buy this bar on close. This, what I just said, is exactly a very valid construction in easy language. That's why I use it for example. If you are able to translate it into MetaTrader, welcome. Could you please give us an indication how successful your approach has been, whether through PNL or some other metric of performance? It's very hard for me to assess the success of my approach using any metric that is used for assessing the quality of a trading system. If you simply mean the metrics of a typical trading system that is considered within the course, then I would say that normally they feature a return to risk ratio of 3-to-1, or perhaps 4-to-1, and mostly we consider ideas that have been consistent and persistent in the markets for at least 15 years, preferably more. So I don't know what else to say. What we should not expect out of this course. You should not expect the Holy Grail after learning the course. Seems like it's just a part of the question, but I don't understand. Where was the beginning? I do quite well in day trading. Why should I switch to algo trading? If you do it quite well, there is no reason for you to switch to algo trading. Look, I am not here to convince you to absolutely go to algo trading and to take our educational course. If you're doing well in day trading, I'm happy to hear that, and I don't think that you need anything else. Because in my opinion, the key benefit of algo trading itself is to get rid of emotions. For example, I'm personally very emotional and I cannot trade manually. I try to do that, but normally in 3 months I start to make well, not mistakes, but something against my own rules. So for me, automated algo trading is the only solution. If we mean the market analysis that lies in the foundation of my method, then again, for me, this is the only solution to survive the markets because they change. And especially the last 2 years were very tough for many traders, not only algo traders, but discretionary traders, fund managers. A lot of funds went into very significant drawdowns during these 2 years. And without understanding the market structure, without being able to do this market analysis correctly, the chances that you will survive the next market phase are very small. So again, I want you to understand that the key thing here is not mathematics or some complex algorithms or weird statistical methods. The foundation of this method, the foundation of success, is the proper analysis of market, of understanding how markets are organized, how they operate, and how they change in time. So this is the clue, the key to success. How is your approach different from other automated system design approaches? I hope that I've just explained that, because it's based on the thorough analysis of the very market you are going to trade, and not just applying some statistical or other mathematical models to it. Does it help in day trading of futures? First of all, I don't quite know what you personally mean by day trading, because there are at least 3 definitions of this term. But if you mean something when you close your positions before the closing bell, then I don't know. In fact, I don't know, because part of the systems that can be generated indeed intraday, but a good part of them, and perhaps the most profitable part, hold positions for a number of days. So if day trading is a value in itself for you, then possibly this is not the ultimate solution. Why do you believe sharp ratio may be misleading for market making HFT strategy? Well, just look at the definition of sharp ratio and you will understand. When we backtested over 15 years, what's the minimum number of trades to meet a good statistical sample? 100. Well, of course, it depends on the frequency of trading. I would say that regardless of the number of trades, but of course, if the system generates only a couple of trades in 15 years, then most likely this is not a system. But other than that, you better look at the distribution of trades in time. For example, if a system generates a trade, I don't know, every month, it would be absolutely statistically significant to have just a couple of hundred trades in 15 years because of the regular nature of these trades. If it generates these 200 trades, but 100 of them is just in 1 year, and another 100 of trades is in other 14 years, then most likely there's something wrong with the system. So again, you should always be reasonable, and you should always understand why your system generates you profit. This is not only about statistics. This is mostly about what market processes that you are exploiting with this system. Is your method more of a top-down development approach to how the market works? Yes, it's top-down. Why do you need to understand the markets? Why can't you simply rewrite? Reweight as performance dictates. Don't quite understand what actually you suggest to reweight, but if you mean something like portfolio rebalance, there is a very great chance to always be past the market, not ahead of it, but behind. For example, you observe the behavior of a system or a portfolio during 2 months, you decide that it's underperforming, you do re-optimization research of parameters, you adjust it, then market changes, and you're always in a drawdown. This is, by the way, exactly why walk-forward test, in fact, is a very great hoax. Perhaps the only modification of walk-forward test, the anchored walk-forward test, may in certain cases be useful. Again, in certain cases under certain conditions. But what you suggest to simply reweight something is the greatest way to always be in a drawdown. In your analysis, do you analyze fundamental data like GDP numbers? Not directly. That is, I personally do not use the actual figures, the actual readings of these economical indicators in my systems. But we do pay very serious attention to how these factors affect markets in short, medium, and long term, which impact they have. And this understanding helps a lot with the design of the systems. So, another question. Would you say that algo trading is more profitable in the FX market than stock markets? I have never said anything like that. I mean, because of speed of movements of exchange rates. Speed of movements of price in any market does not mean that you are able to benefit from these movements. So volatility and speed of movement, as you say, do not only guarantee, do not mean anything about the potential performance of this market, but also because of forecast done by your system. None of the systems that I make and none of the systems that are generated using our approach forecast anything. We do not do forecasts. Forecasts are for professional market analysts and economists. The trading system, a robust trading system, only allows you to be adequate to the market under certain market conditions. We do not forecast anything. We do not forecast prices or any future development of the market. We only believe that under these conditions, we have a positive mathematical expectancy of our trade if we do this, this, and this. That's all. You base your decision on forecast. No, I do not base my decision on forecast. I've just explained it. And I already was going to say goodbye. Okay, what is the good assumption for slippage in FX? So for the sake of backtesting, it depends on the trading size and the trading venue you trade. In interactive brokers and their ideal pro ECM during most liquid hours, if your trading size is below 1 million base currency, then the normal slippage, or let's say trade expenses, including commission or possible slippage and spread, will be somewhere around 1 pip, perhaps a little bit less. If you trade 10 million with such an ECN, then it may increase to 2 pips, perhaps 2.5. So for these amounts, you better go to a more liquid ECN. If you want to ask about any MetaTrader dealers, then I cannot comment on that because I do not work with retail forex brokers. Okay, now I believe that's the end of questions. So again, Let me say thank you very much for attending today's webinar, and thank you for your attention. And let me remind you once again that in case you have further questions, please feel free to write anything to info@atssm.com, and be sure to check our YouTube channel because the video of this webinar will be there soon, and also you can review the videos of the previously recorded webinars that are already there. So thank you very much. Have a nice day. Have a great weekend, coming weekend, and see you again next Wednesday.